Hello friends, in this video we will discuss income statement, or it is also called profit and loss statement, or P&L for short. This statement reports company's operating performance for a specific period. It can be a day, a week, a month, or a year, depending on which period you want to look at to see if the company was profitable or not. You can also compare different periods to see the trend in operating performance. So in this statement we have revenues from our products and services, and then we deduct all the costs related to our operating activities. So these are raw material expenses, salary expenses, rent expenses, marketing expenses, finance expenses, and tax expenses. And after we deduct all these operating expenses, we get our profit or loss for the period. Now let's have a look at the income statement, how it looks like. At the top we have revenue and from our products and services, and then we have cost of goods sold. These are expenses related to making the product or service. So for example, for our lemonade business, this would be lemons, oranges, and celery expenses for the person who is making the lemonade. And after we deduct our costs from revenue, we get our gross margin. And after gross margin, we have operating expenses. These are expenses which are not directly related to making or delivering the product. So these are office expenses, salary expenses of employees who are not related to making the product. These are marketing expenses, utility expenses, and insurance expenses, and research and development expenses, and all the other operating expenses that are not related to making the product. Then after operating expenses, if we deduct operating expenses from gross margin, we get operating income. And after operating income, we have finance income and expenses. So we get finance income from our stocks or bonds, and we get expenses if we have loans, and this would be our interest expense. So if we add finance income to our operating income and deduct finance expenses, we get profit before tax. After profit before tax, we have income tax, and when we subtract income tax from profit before taxes, we get our net profit or loss for the period. Now, for you to understand better, let's have a look at our lemonade stand business. Let's imagine that we worked for 1 week and we want to look at our operating performance. So at the top we have revenue. We sold 90 cups for $3 each, and we have, out of these 90 cups, 20 were sold on credit to friends. So they promised to pay us later. But we record all 90 cups because we made the transaction already, and economically we did everything from our side to deliver the product. So we can record all 90 cups as revenue. So 90 cups multiplied by $3 per cup equals $270. Then we have cost of goods sold. Here we have 50 cents of ingredients per cup and 50 cents for each cup, for each plastic cup. So we have $1 of raw materials per cup multiplied by 90 cups. We have $90 of raw material expenses. Then we have salary expenses, which are $15 per day. So we multiply $15 by 7 days and get $105 of salary expenses. Then we have depreciation of our property, plant and equipment, and we estimate that our property, plant and equipment has 2 years of useful life. And for you to understand better the amortization and depreciation expense, I think it would be better to make an example of a taxi driver. So let's imagine that you paid your taxi driver $10 for your trip, and the cost of goods sold, in this case gas, was $2. But the main expense of the taxi driver is amortization of his car. So in his case, it can be $4 or $5 of amortization expenses of his car for the trip that he's made. And we have $2 of gas and $5 of amortization expenses, so he will have $7 of cost of goods sold. So in our case, we have depreciation of our lemonade stand and of our equipment. And if you remember, we had $1,000 of property, plants and equipment, our lemonade stand and the mixer. And with 2 years useful life, if we divide 1000 by 2 years, we get our annual depreciation. And then if we further divide by 52 weeks, we get our weekly depreciation of our property, plant and equipment. So in this case, we have $10 of depreciation. And now if we add $90, which are raw materials, add $105 of salary expenses and $10 of depreciation amortization expenses, we get $205 of cost of goods sold. Then if we subtract $205 from our revenue, we get $65. This is our gross margin. Then we have operating expenses. For our lemonade stand business, we only have marketing expenses as operating expenses. So here we have Instagram ads at $5 per day. So 5 times 7 is $35. So if we subtract $35 from $65 of gross margin, we have operating income of $30. Then we have finance expenses. If you remember, we have a $500 loan at 20% annual interest rate. If we divide 20% by 52 weeks, we get our weekly interest rate. And if we multiply it by 500, we get an interest rate of $2 for week 1. And if we subtract $2 from our operating income of $30, we get our profit before tax of $28. Then we have income tax. We have income tax of 20%. So 20% of $28 is $6. And we have a net profit of $22 for our first week. Now I want you to build P&L for week 1 for our lemonade stand business yourself. And you can again take a piece of paper and line by line record revenues, costs, operating expenses, financing expenses, and then you can see the answer on the screen.